They told you they stopped it. They told you the digital dollar was banned, and for a moment, it felt like you won. But you did not. Because what they banned was only one version of the system, the part you were supposed to see. Everything else is still running, already built, already tracking, already deciding. And if you think this does not affect you, you are already inside it. Here is what actually happened. On July 17, 2025, the House of Representatives passed the CBDC Anti-Surveillance State Act, Bill number HR 5403. The vote was 219 to 210. The bill prohibits the Federal Reserve from researching, designing, building, testing, or issuing a central bank digital currency without explicit authorization from Congress. Then, in March 2026, the Senate passed its own version, barring the Fed from issuing a CBDC or using any intermediary to do so on its behalf. Before that, on January 23, 2025, President Trump signed an executive order prohibiting federal agencies from establishing, issuing, or promoting a CBDC. 3 separate actions: the House bill, the Senate bill, the executive order, all targeting the same thing: a central bank digital currency issued directly by the Federal Reserve. That is the part they banned. This is not a future system. This is already decided. Now here is the part nobody is talking about. FedNow, not mentioned. Stablecoins, not only not banned, Congress passed a separate law making them legal and regulated. The Genius Act, signed July 18, 2025. Merchant category codes, not mentioned. The system scoring your account right now, not mentioned. The digital euro being built in Europe as you watch this, obviously not mentioned. And here is where it gets dangerous. Because the architecture of financial control does not live in one place. It does not need a single system called a CBDC. It lives in your bank, your card, your phone, your transaction history, already connected, already running, already making decisions about you. In July 2023, the Federal Reserve launched FedNow. Not a CBDC, every official will tell you that. FedNow is a payment settlement system. It moves money between banks instantly, 24 hours a day, 7 days a week, 365 days a year. As of January 2026, more than 600 banks and credit unions are connected. That number grew from 100 at the end of 2024 to over 1,600 in just 12 months. Tens of thousands of transactions per day. Right now, through your bank, that is already live. And here is what is built into it: mandatory fraud reporting. When a participating bank suspects a payment, they are required to report it to the FedNow network. Not optional, required. Real-time transaction flags, risk controls that can hold or reject your payment without warning. Monitoring infrastructure on every single transfer. The Federal Reserve says FedNow is not a CBDC, that privacy rules are governed by existing law, that this is just faster payments. That may be technically accurate, but this is the part people ignore. FedNow is the rail. If you wanted to build a system that moves digital currency instantly across 1,600 financial institutions with built-in reporting, monitoring, and the ability to freeze transfers, you would build exactly what FedNow already is. The rail is there, the banks are connected, the reporting obligations are already live. What happens when your bank files a fraud report through FedNow? That report enters a network shared across every participating institution. Other banks can see the flag, the pattern gets logged. Your account is now associated with that report, and you will never receive a notification that any of this happened. The only thing missing from this infrastructure is the political decision to put a government-controlled token on top of it. That is what the ban prevents, for now. That is not a theory. That is the infrastructure that exists today. Now here is where it gets personal. Every time you use your card, the merchant you buy from is assigned a 4-digit number, a merchant category code. Your grocery store has one, your gas station has one, your gun store has one. In 2022, ISO approved a new merchant category code, specifically for firearms and ammunition retailers. The reason was simple. If your bank can see not just that you made a purchase, but that your purchase was made at a firearms dealer, your transaction is now categorized, flagged, reportable. Card networks announced a national rollout, then paused in March 2023 when states went to war over it. California passed a law requiring the gun code. Colorado passed a law requiring it. Texas passed a law banning it. Florida passed a law banning it. There's a live legal battle happening right now in the United States over whether your bank should be able to automatically identify and separately track your firearms purchases. And here is what that fight is actually revealing. This is not new. The debate about the gun code is only happening because firearms is the one category where people pushed back loudly enough to be heard. Every other purchase you make is already coded, already categorized, already in your bank system. Every casino transaction, every political donation platform, every cryptocurrency exchange, every international wire. Every purchase at a business, your bank considers elevated risk, already in categories, already flowing through your risk profile, already being used to decide whether your account looks normal or needs a closer look. And this is where it gets serious. Under the Bank Secrecy Act, if your bank believes you have made transactions totaling over $5,000 in a pattern that looks suspicious, they file a suspicious activity report with the federal government without telling you. Federal law prohibits them from telling you. You have no legal right to know if your bank has filed a federal report about your spending. None. Not a notification, not a letter, nothing. That report goes to the Financial Crimes Enforcement Network. It gets stored. It can be accessed by law enforcement. It can be shared across agencies. And your account keeps running as normal, as if nothing happened. Because you were never told that is already happening across America, right now. And here is the part that connects everything. Your bank is not waiting for you to do something wrong. Your account is being scored right now. Every transaction you make is categorized and compared. Every pattern is measured against your own history. Every deviation from your normal behavior triggers a flag. Your risk profile is built from your transaction history, your counterparties, your geography, your business type, your login patterns, the device you use to access your account. The time of day you log in, algorithms run on this data continuously. And if your score crosses a threshold, your account gets flagged. Sometimes that means a fraud alert. Sometimes it means a request for documentation. Sometimes it means your account is closed with a letter, citing policy. No explanation of the actual reason, no process to challenge it, no right to appeal. This is not a future possibility. This is the current operating model of every major bank in America. In 2024, TD Bank was fined over $3 billion by federal regulators, not for stealing from customers, for failing to monitor them adequately. The message sent to every bank in the country was explicit. If your surveillance of your own customers is not robust enough, you will face consequences. This dynamic has a name, Operation Chokepoint 2.0. In 2025, the House Financial Services Committee released a report alleging that federal regulators under the previous administration applied informal pressure on banks to cut off services to cryptocurrency companies, not through law, not through regulation, not through any official order, through supervisory conversations, through what gets asked during bank examinations, through what regulators quietly signal is acceptable business and what is not. Two banks that served crypto companies heavily, Silvergate and Signature, were gone by the end of 2023. No law required that outcome. The pressure alone was enough, and the message was received by every other bank in the country. If you serve certain clients, you will attract scrutiny you cannot afford. So those clients lost their banking relationships. Not because they broke the law, because their bank decided the risk was not worth it. Perfectly legal businesses. No charges filed, no process, no appeal. Just a letter citing policy. In 2025, President Trump signed an executive order on debanking, directing agencies to ensure people are not denied financial services for political or religious reasons. The OCC announced moves to depoliticize banking supervision. And these are meaningful signals, but here's the structural reality that does not change with any administration. The risk scoring systems remain, the reporting obligations remain, the supervisory pressure tools remain, the regulators who decide what counts as risky change every 4 years. The infrastructure they use to act on those decisions does not. And here's where this becomes a global story. On October 30th, 2025, the European Central Bank's Governing Council made an announcement. The digital euro project was moving to its next phase. Not canceled, not under review, not slowed. Next phase, a 12-month live pilot starting in the second half of 2027. Real banks, real merchants, real transactions, real people's money. If EU legislation passes in 2026 as planned, the first issuance of the digital euro could happen around 2029, 3 years away. The ECB says the digital euro will complement cash, privacy technology will be used, data held by the central bank will be pseudonymized, but organizations like Privacy First, which have tracked this project from the beginning, have warned publicly that Europe may be sleepwalking into the digital euro, that the architecture being built enables something that privacy promises alone cannot stop. Permanent, centralized, searchable records of how every citizen across the entire Eurozone spends their money, every transaction, every category, every pattern. And here is the connection that should concern you. Italy, France, Spain, Greece, Portugal, all of them already have laws capping cash transactions above certain amounts. These laws predate the digital euro project, but put them together and you see the pattern clearly. First, restrict what cash can do legally, then introduce a digital alternative that works everywhere cash cannot. The result is not a ban on cash. It is a system where cash becomes progressively less useful, less accepted, less practical, while the digital alternative is already built, already available, and increasingly the only option that works. And at that point, The choice is no longer between surveillance and freedom. It is between using the system or being excluded from economic life entirely. Here is what the CBDC ban actually bought you. Time. It stopped one specific architecture, a Federal Reserve token issued directly to citizens. That would have been the most visible and direct form of financial control ever built in America. And stopping it was meaningful. But you do not need a new system to control money. You just need to connect the systems that already exist. Put 600 banks on a real-time payment network with built-in mandatory monitoring, a 4-digit code categorizing every purchase you make, a risk score running on your account right now without your knowledge, regulatory pressure that can close entire industries out of banking without passing a single law, and in Europe, a system going live in 2029 that makes all of this permanent. None of that required a CBDC. All of it was already running the day the ban was signed. Most people will ignore this. Most people heard the headline, celebrated the win, and moved on. And that is exactly what the system was counting on. Here is the part they will never explain to you, because once you understand what is actually built and how it already connects, you stop looking at your bank account the same way. You stop assuming that having money means you control it, and you start asking a different question entirely. Not whether the system can control your money, but whether it already does. That is what we are breaking down next week. Because there's a law already on the books in the United States that allows your bank to take your deposits and convert them into shares of a failing bank during a financial crisis, without your permission, without advance notice, without any legal obligation to make you whole. It has already happened in Europe and Cyprus. In 2013, depositors woke up one morning and a percentage of their savings had been converted into stock in a bank that was collapsing. The US legal framework for the same thing to happen here already exists. Your bank will never explain this to you. Subscribe to Capital Awareness now, turn on notifications, because the next video is the one the system is counting on you never seeing.